If you are over 65 and you keep money in a bank account, the next few minutes could save you thousands of dollars you did not even know were at risk. Right now, banks are quietly sending reports to the federal government about routine money moves that older Americans make every single day. Some of these moves trigger automatic flags, some trigger audits, and some, without any warning at all, can freeze the account you depend on for rent, for medicine, for your grandchild's birthday gift. Most seniors never hear about this until it is already too late. That is about to change. In this video, I'm going to walk you through 7 ordinary bank account moves that are drawing fresh attention right now, why the rules around them have quietly tightened, and exactly what you can do to stay safe, stay legal, and stay in control of your own money. Stay with me, because the first one alone catches thousands of retirees off guard every single year, and by the time we reach the 7th, you will understand why so many financial advisors wish their clients had seen this video 5 years earlier. Let's start with the move that has tripped up more retirees than any other this past year. It involves cash. If you walk into a bank branch and deposit more than $10,000 in cash, your bank is legally required to file what is called a currency transaction report. That report goes straight to the federal government. It includes your name, your account number, the amount, and the date. The bank does not have to call you first. They do not have to warn you. They do not have to ask if you have a good reason. They simply file it, and then they keep going about their day. For most people, this is not a problem. The IRS uses these reports to spot illegal activity, not to penalize ordinary folks. But here is where seniors get caught. After decades of saving, after finally selling a piece of property, after cashing out a small business, or after receiving an inheritance paid in old-fashioned bills, you might be depositing more than $10,000 in a single visit. That single visit just puts your name on a federal list. If you do it once, it is usually fine. If you do it several times within a short window, questions start to pile up. Even worse, if the cash came from a personal savings account or from a family member, the bank still has to file the report. There is no exception just because the money is yours and was earned legally. So the very first move to watch is any large cash deposit, especially if you are stacking several of them close together. The simple fix is to keep good records. A printed statement showing where the money came from, a copy of the property sale, or a note from the relative who provided the funds can save you weeks of worry if the IRS ever calls to ask about it. Before we move to the next pattern, I'd love to know in the comments if anything here has already happened to you or someone you love. Your story might help another viewer avoid the same mistake. And if this video is giving you value, a quick like and subscribe really does make a difference. It tells the algorithm that more seniors deserve to hear this kind of information, and it helps me keep making videos like this for free. Here is where things get very serious. Let us talk about the move that the federal government treats as an actual crime, even when the money involved is completely legal. It is called structuring. Structuring happens when someone breaks up a larger cash deposit into smaller pieces on purpose so that each piece comes in below the $10,000 reporting line. Imagine you have $18,000 in cash from the sale of an old car. You go to the bank on Monday and deposit $9,000. You come back Wednesday and deposit another $9,000. On paper, nothing triggers a report. But the bank and the IRS are trained to look for exactly this pattern. They watch the dates, the amounts, the teller, the branch, and the account holder. When they see consistent deposits that hover just under the threshold, they can flag the account, open a case, and in some situations, refer the matter for criminal prosecution. Federal law makes it clear that structuring is illegal under Section 5324 of the United States Code, even if every dollar you deposited was earned honestly and reported on your taxes. The reason the law is written this way is that the government wants banks to be able to spot suspicious patterns without anyone having to prove intent. So here is the warning. If you are a senior who keeps cash at home, even for safety or convenience, do not try to be clever with how you deposit it. If you have a legitimate amount above $10,000, deposit it cleanly, save your receipt, and keep the paperwork that explains where it came from. Trying to be clever is far riskier than simply being honest. And if a bank teller has ever suggested ways to deposit cash in smaller amounts to avoid paperwork, that is itself a red flag about that bank, not advice you should follow. If this kind of breakdown is helpful, please take a second to hit the like button right now. It costs you nothing, but it helps this video reach another retiree who might be one deposit away from a serious problem. And if you have not already, tap subscribe and ring that little bell so you never miss an update when the rules shift again. The next move that is quietly catching seniors off guard has nothing to do with cash at all. It has to do with retirement accounts that you have been watching grow quietly for decades. Starting at a certain age, the IRS requires you to withdraw a minimum amount from most traditional retirement accounts every year. These withdrawals are called required minimum distributions, often shortened to RMD. The current starting age is 73 for most people, and it is scheduled to rise over time. Here is the trap. Many retirees either forget about RMDs completely, or they assume that because they are still working, or because they do not need the money, the rule does not apply to them. Unfortunately, the IRS does not care whether you need the money. If you miss an RMD, or if you withdraw less than the required amount, the penalty used to be 50% of what you should have taken. Recent rule changes have reduced that penalty significantly, but it is still severe and it is still automatic. The IRS does not need to audit you to charge it. It simply sends the bill. For a senior living on a fixed income, even the reduced penalty on a missed distribution can wipe out an entire year's worth of careful budgeting. The fix is simple once you understand it. Talk to your plan administrator in the spring of each year. Ask them to calculate your RMD for that year. Many will do it for free. Then schedule the withdrawal before December 31st. If your situation is complicated, a short conversation with a tax professional can save you thousands. The point is, RMDs are not optional, they are not negotiable, and they are not something the IRS will let slide just because you are retired. Quick reminder before we go deeper. If you are finding value in this, please leave a comment telling me which move has surprised you most so far. The conversation in the comments is often as helpful as the video itself because real stories from real viewers catch details that I cannot fit into one script. And of course, like and subscribe if you have not already. The fourth move that has been quietly drawing a lot of attention involves money that is parked outside the United States. Maybe you have a small savings account in the country where you were born. Maybe you keep a brokerage account in Canada because that is where your grandchildren live. Maybe you receive a pension from a former employer overseas. Whatever the reason, if the combined balance of your foreign financial accounts crosses $10,000 at any point during the calendar year, the United States government requires you to file a separate report called an FBAR, which stands for Report of Foreign Bank and Financial Accounts. This is not a regular tax return. It is not optional. It is filed on a different form with a different agency, and it carries its own penalties if you skip it. What catches seniors off guard is that FBAR penalties have historically been brutal. Even a non-willful failure to file can carry a penalty of around $10,000 per violation, and willful failures can multiply that number fast. The good news is that the IRS has worked to soften some of these penalties for people who were simply unaware. The bad news is that the rules still have teeth, and a foreign account you forgot about for a decade is exactly the kind of issue that puts a friendly letter from the IRS on your kitchen table. The simple move is to make a list of every account you can access anywhere in the world, including retirement accounts and brokerage accounts. If the combined total ever crossed $10,000, assume the report is due and file it. There are filing extensions available, but the safest path is to file on time every year with all the disclosures accurate. Before I keep going, would you do me a small favor? Tap the like button on this video. It only takes a second, and it really does help this information reach people who need it most. Also, if you have friends or family who are retired and still banking the old-fashioned way, share this with them. The next move is one they really need to hear about. The fifth move is one of the quietest and most painful, and it catches many families completely by surprise. It involves joint bank accounts. If you add a child's name, a grandchild's name, or a caregiver's name to your bank account, you might think you are simply making life easier. In reality, depending on how the funds move, you may have created a gift. The IRS treats large transfers from your personal account into a joint account as a potential gift to the other named owner. If the amount exceeds the annual gift tax exclusion, which currently sits around $19,000 per recipient, you may be required to file a gift tax return even if no actual tax is owed. Most people do not know this rule exists. They add their daughter to the account so she can help pay a bill if they end up in the hospital. They move $25,000 into that joint account to cover a home repair. Suddenly, they are staring at a filing requirement they never knew about, and they have already missed the deadline. Even worse, when the senior later passes away, joint account rules can complicate the probate process. Money that everyone thought would pass smoothly to the children can become tied up in legal review, and the IRS can ask questions about whether the contributions were gifts, loans, or shared property. The fix is straightforward. Talk to an estate attorney or a tax professional before adding anyone to your account. Keep a written record of who contributed what, and if large transfers are needed, structure them to stay within the annual exclusion so you stay out of reporting territory you do not need. If you have made it this far in the video, you are clearly serious about protecting your retirement. That tells me you are exactly the kind of viewer I make these videos for. Please hit subscribe so I can keep showing up in your feed with updates that matter, and leave a quick comment telling me whether you have a joint account with a family member. The discussion below often saves people from making the same choice twice. The sixth move is one that almost no one talks about, but it is one of the most common reasons an older American gets a knock on the door from the bank. It involves large, unusual withdrawals. Banks are required to file a suspicious activity report whenever they see transactions that look out of character for the customer. The report can be triggered by a single very large withdrawal. It can also be triggered by a pattern of smaller withdrawals that, taken together, look unusual. For seniors, this often shows up in two ways. The first is when a retired person suddenly withdraws tens of thousands of dollars to pay for a medical procedure, to help a relative in trouble, or to buy a second home. The second is when a senior becomes the target of a scam and starts making rapid withdrawals under pressure from someone on the phone. In both cases, the bank has a duty to flag the activity. In some cases, the bank will simply file the report and let the withdrawal go through. In other cases, the bank will place a temporary hold, ask questions, or refuse the transaction outright. That hold can be terrifying if you need the money urgently. The way to protect yourself is simple but rarely discussed. Build a relationship with your banker. Tell them in advance if you are planning a large purchase, a property sale, or a major medical expense. Many banks will quietly note your file so the withdrawal does not look unusual when it finally happens. If you ever feel pressured by a phone caller to move money quickly, hang up and call your bank directly. That single habit has saved more older Americans from losing their life savings to fraud than almost any warning the government has ever issued. We are getting close to the most important move of all, but first I want to thank you for staying with me this long. If this video has earned your trust, the best way to thank me back is to share it with one person you know who is retired. You can use the share button right below this video. That one share might be the reason someone avoids a bad situation next year. Now we come to the seventh and most consequential move, the one that financial advisors say has caused more confusion in the last 3 years than almost any other rule change in the tax code. It involves inherited retirement accounts. When you inherit an IRA from a parent, a spouse, or another relative, you cannot simply let it sit forever. Under current law, the entire balance of most inherited IRAs must be distributed by the end of the 10th year following the original owner's death. During those 10 years, you either take the money out according to a set schedule, or you take it all out in the final year. Either way, the distributions are taxable as ordinary income. Here is where seniors and their children get caught. A surviving spouse who is also retired might think they can roll an inherited IRA into their own retirement account and forget about it. In many cases, that is no longer allowed. An adult child who inherits a traditional IRA might assume they can take small withdrawals and stretch the tax hit over many years. The 10-year rule has ended that strategy for most non-spouse beneficiaries. If you fail to follow the rule and the IRS later reviews the account, the missed distributions pile up, and so do the taxes. In some cases, the family ends up with a 5-figure tax bill that nobody budgeted for. The fix here is not glamorous, but it is critical. The moment you inherit any retirement account, talk to a tax advisor before you take a single dollar. Plan the withdrawals so they happen in years when your income is lower. Coordinate with your other income sources. And never assume that leaving the money untouched is the safe move. With inherited IRAs, doing nothing is often the most expensive option of all. We are almost at the end, and I want to make sure you walk away with everything you need. If this video has helped you, the smallest gesture of support, a thumbs up, a comment, or a subscription really does add up. It tells the algorithm that this kind of information matters, and it keeps this channel going. So let us pull everything together in a way you can act on today. Watch large cash deposits that climb above $10,000, and keep clean records of where the money came from. Never break cash into smaller deposits to slide under that line. The law treats that as a crime even when the money is yours. Honor your required minimum distributions every year once you reach the required age, because the IRS charges an automatic penalty if you miss them. Make a list of every foreign account you can access, and if their combined value ever crossed $10,000, file the special foreign account report on time. Think twice before adding a family member to your bank account, because large contributions to a joint account can quietly trigger gift tax filing. Build a real relationship with your banker so large withdrawals do not look alarming, and watch out for phone pressure that pushes you to move money fast. And the moment you inherit a retirement account, talk to a tax advisor before you take a single dollar, because the 10-year rule has changed the game for almost everyone. These are not exotic tax tricks or complicated loopholes. They are the basic guardrails of modern banking, and they touch nearly every retired household in the country. The fact that most people never hear about them until something goes wrong is exactly why I keep making videos like this one. If you remember nothing else from today, remember this. The IRS does not need to suspect you of anything to take an interest in your accounts. They only need your bank to file a single routine form with your name on it. The best defense is not fear. The best defense is preparation, good records, and a short conversation with a professional before you act. If this video helped you protect even $1 of your retirement, please leave a like, subscribe to this channel, share it with someone you love, and drop a comment below telling me which move you are going to act on first. I read every comment, and your story might be the one that protects another viewer tomorrow. Thank you for spending your time with me today, and I will see you in the next video.